a well-known investor, someone with a real track record of calling a major crash correctly in the past, publicly bet against the stock market a couple of years ago. Plenty of regular people made that same bet right alongside him, waiting on the sidelines for the correction everyone was sure was coming. In the years since, the market didn't just recover, it climbed dramatically higher. And the people who sat in cash waiting for the crash watched their paycheck buy less every single month while they waited. I want to talk about why that happened, why it keeps happening on a predictable cycle, and why the honest answer isn't that those people were bad investors. It's that they were playing a game most people don't realize they're even in. Start with the actual mechanism, because this isn't random and it isn't a coincidence that shows up once and disappears. Compare the size of the stock market to the size of the money supply, meaning how much currency actually exists in the system at any given time. And that relationship has stayed remarkably flat for close to 2 decades. Every record high headline, every green day, every all-time high that made people feel like they were finally getting ahead, when measured against how much money actually exists in the system. Most of that feeling of progress is an illusion created by the currency itself losing value, not by companies suddenly becoming dramatically more valuable underneath the surface. Here's why that matters for how you should actually behave with your own money. Because this is where most people go wrong. A huge share of the country now has meaningful exposure to the stock market, directly or through retirement accounts. And asset prices going up or down has become closely tied to whether the broader economy looks healthy on paper. When most of the spending in the economy comes from people who own assets, and those asset prices fall hard and stay down for a long stretch, spending drops with them, and the numbers everyone uses to judge whether the economy is doing well start looking a lot worse. That creates enormous pressure on the people in charge of the money supply to step in and support asset prices whenever things start looking genuinely shaky. Not because anyone announces that plan out loud, but because the alternative causes a much bigger and much more visible problem for everyone involved. Look at how that's actually played out historically. A serious downturn a little over 15 years ago took years to fully recover from. A separate sharp downturn a handful of years back recovered in a fraction of that time. Each rescue effort has tended to arrive faster and land harder than the one before it, because the system has increasingly leaned on aggressive intervention every time real stress shows up in the financial plumbing, not just in stock prices themselves, but in the actual mechanics that keep credit and lending functioning smoothly behind the scenes. That's the part people miss. It's not really about protecting your account balance specifically. It's about making sure the underlying financial system keeps functioning, and protecting asset prices tends to be the side effect of doing that. Now, here's the part that actually matters for how someone should invest. Because I think a lot of people hear all of this and land on exactly the wrong conclusion. The instinct is to say, okay, so the whole thing is rigged, so I should wait for the inevitable moment it finally breaks and buy in cheap at the bottom. That's precisely the mistake the investor I mentioned at the start made. And it's the same mistake plenty of ordinary people watching him make it fell into as well. Waiting for a crash that keeps getting delayed, or softened, or rescued before it fully plays out means sitting in cash the entire time. And cash sitting still isn't neutral. It's actively losing purchasing power every single month. It sits there doing nothing, especially during exactly the kind of period where a lot of new money is being created in the system. This is genuinely the core reason I don't try to time entries around waiting for a crash, a correction, or some perfect moment that feels safer than right now. I buy every single month, automatically, regardless of what the headlines are saying about valuations being stretched, regardless of predictions about an inevitable correction, and regardless of how convincing any individual argument sounds in the moment. Being wrong about the timing of a crash that never quite arrives on schedule or arrives and gets rescued faster than expected has historically cost people far more than just staying invested the entire time ever would have. Let's also talk about why the recovery windows keep getting shorter each time, because I think understanding that mechanism changes how you should feel about missing any single dip. Every time a serious downturn threatens the underlying financial plumbing, not just stock prices, but the actual credit and lending system underneath them, the response has tended to arrive faster than the previous one. A downturn that once took years to fully recover from eventually gave way to one that recovered in a matter of months. If that pattern continues, and there's no obvious reason it wouldn't, it means the gap between a scary headline and the market fully recovering keeps shrinking over time, which means the actual window, where sitting in cash pays off, keeps shrinking right along with it. Betting on being able to time your way into that shrinking window precisely enough to catch the bottom and get back in before the recovery is a much harder bet than it sounds like in the moment, and it's gotten harder with every cycle, not easier. I also think it's worth being honest about the emotional side of this, because the logic only matters if you can actually stick with it when things get uncomfortable. Watching a portfolio dip while headlines get louder about an inevitable collapse is genuinely uncomfortable. And it's supposed to be. That discomfort is exactly what convinces so many people to step aside at precisely the wrong moment, sell into the fear, and then either miss the recovery entirely or get back in late after most of the gains already happened. The people who avoid that outcome usually aren't smarter about predicting the bottom. They're just automated enough and detached enough from checking constantly that the emotional moment never gets a chance to override the plan they already set. I also want to talk about why a small slice of my own portfolio sits in something like Bitcoin, because the reasoning connects directly to everything I just walked through, and I don't want to overstate it into something it's not. The core idea behind holding a small allocation to an asset with a genuinely fixed, unchangeable supply is straightforward. When new money gets created in large amounts, that new money has to go somewhere, and it tends to flow disproportionately into assets that can't simply expand their own supply to soak it up. Real estate, stocks, and hard assets with limited supply tend to benefit from that dynamic over long stretches of time, while cash sitting still tends to lose ground the entire time it's parked. That's the actual rationale behind the 15% allocation, not a prediction about where the price goes next month or next quarter. Because I genuinely don't make those predictions, and I'd be skeptical of anyone confidently telling you they can. I want to be careful here too, because this kind of topic tends to attract a lot of overconfident forecasting, and I don't think that serves anyone well. Nobody knows exactly when the next serious downturn happens, how deep it goes, or how quickly it gets rescued this time compared to the last time. What's actually knowable and what's held up across a long stretch of history is that trying to sit out of the market waiting for the perfect entry point has a worse track record than simply staying invested the entire time and letting the boring, automated process keep running regardless of the narrative dominating headlines that particular month. There's a human cost to all of this that doesn't show up cleanly in a chart, and I think it's worth naming directly. A lot of people, especially younger people, are genuinely struggling right now, even while asset prices sit near record highs. And those two things aren't actually in conflict with each other. They're connected. When newly created money flows heavily into assets, the people who already own those assets tend to benefit disproportionately, while the price of everything else, groceries, rent, basic goods, tends to climb for everyone regardless of whether they own any assets at all. That's part of why owning something, even a small, boring, automated position, matters over a long enough timeline. It's not about beating the system or predicting its next move. It's about not being entirely on the losing end of a dynamic that's been playing out consistently for a long time now. So here's what I'd actually want someone to take away from all of this. Instead of walking away either panicked or convinced they need to time some perfect entry point, the urge to wait for a crash before investing feels responsible in the moment, but the historical record doesn't really support it working out better than just staying consistently invested the whole time. Money sitting in cash waiting for a better moment is quietly losing value the entire time it waits, particularly during periods when a lot of new money is entering the system. And a small automated allocation to assets that can't simply expand their own supply on demand is a reasonable piece of a long-term plan, not a bet on some dramatic collapse, and definitely not something you should be trading in and out of based on whatever headline is dominating that particular week. None of this requires predicting the next crash correctly, guessing when the next rescue happens, or reading every headline about the Federal Reserve like it's going to tell you exactly what to do with your account tomorrow. It requires staying automated, staying diversified, and accepting that the boring, consistent version of this plan has simply outperformed the version where you wait for permission from a headline that may never actually arrive on the timeline you're hoping for. If you want the full breakdown of exactly how I think about balancing cash, stocks, and that 15% Bitcoin allocation against each other month to month, let me know in the comments and I'll walk through that one next.